Welcome to the first episode of Trust to Traction. And this is your host, Stefan Furcoi, for this podcast. This first episode is special, and we'll be starting with something that fewer people talk about, what has to exist before capital, before founders, institutions, and users can actually trust the opportunity. Today's conversation is about that missing layer, the infrastructure behind investable Web3 ecosystems. My guest for today is Nelson Lopez. Nelson has built across venture acceleration, crypto operations, capital formation, and emerging market ecosystems. He has led the XFounders Accelerator. Probably you already heard of it. Some episodes are still available on YouTube. He's worked globally across Gate.io and 1inch. And now he advises funds and startups through DeWe Partners with a particular focus on digital infrastructure and investment ecosystems in Latin America. And it's a pleasure to have you here. Thank you so much for being my first guest. Before we get into markets and capital, I want to understand the human side of things. We're only starting with a person in this industry, and you've worked with founders under pressure, teams scaling globally, and people trying to build in unfamiliar markets. What has that taught you about the psychology of building?
Very cool. Well, first of all, I want to say I'm honored to be with you today. We did meet in 2020, so amazing year for digital assets in general as well. And who would think that 6 years later, going on 7, we would be coming almost like full circle, completely different market, I guess, like different lives for both you and me. But we stayed connected, and I've been honored to watch you grow as well. And now culminating in this podcast, first episode, the Genesis edition. I'm super proud to be here. So, Stefan, you remain a dear friend, and I look forward to see what you make this turn into. On your question, it's interesting. Mostly what I found is kind of this confirmation of what are founder qualities that I appreciate in general, chief amongst them. So number one being discipline. I found that across narratives, across markets, across industries, the number one human quality I look for in people in general, but founders specifically, is discipline. So I'll give you an example, not to jump right into emerging markets, but
that's very interesting. Yes, please go.
You think so? I mean, I've observed Southeast Asia, I've observed Dubai, I've observed San Francisco. Now I'm observing and living in El Salvador, so Central America. And when you go to emerging markets, you find this discipline in founders, which I appreciate, which makes them focus on solving problems that exist today. Because emerging markets are often undercapitalized. This means nobody's throwing money at them to solve problems that might exist maybe 7 years from now. If you find a startup that has survived the 2-year hump, let's say, in an emerging market, for sure, they're doing so over revenue. Yes, which tells me they're solving somebody's problem. So they don't get distracted with secondary product lines, with trying to solve problems that might exist down the line. They're sharp and focused on solving today's problems. That's a great example of founder discipline that I find in emerging markets, and also why I moved to one, so I could follow up on startups and on founders who observe this discipline. Also, if I may, discipline is what keeps founders making smart decisions when the temptation comes in, because it's easy to make wrong choices if you don't have the discipline to hold up to your values, obey your own orders, not start to rationalize what you once called unacceptable. So it's also a huge, let's say, signal of trust for me and a founder when I find that discipline, because not just when things get hard, but when things get easy, it'll be easy for them to make some very wrong decisions that impact them, impact the teams, impact the people around them. And saying no to those temptations is also super important. So I would say overall, what it's taught me is to value and appreciate and look for discipline as the number one value that I look for in founders.
I guess it's not
100%.
just the code, right? It's more than that, right? So in the end, when you say some of the temptations that these founders might go through, would you be able to give us like 2, 3 examples in the context? But I'm looking at something overall, not just like in a code, because this we understand that in building there are things that you might implement new. That's another aspect. Maybe we'll come back to we'll circle that later,
For sure.
because there's that temptation to keep adding options, futures, and maybe that's one of the things also that founders might get tempted to. But overall, in operational decisions and where the company is, you mentioned 2 years. Companies that you see already launched for 2 years and they keep going strong. So somebody that reaches that level, what are some temptations they might face?
Temptations come at you every day, man. It's with a product, adding features that you think you're so smart for adding, and they're vanity features. They're not features that are going to solve anybody's problem. Your customers aren't asking for this feature. Why are you spending money, time, resources, team developing something that it's a little bit of a pride project for you, but your customer base isn't asking for? Even before that, when you're raising, for example, it's very easy to not resist the temptation to overpromise. And if an investor or a capital allocator says, oh, it would be great if you could have this and this on your roadmap or as a feature, or can you deliver this specifically for my own needs? As, for example, an enterprise that engage with you, it's very easy to overpromise and say yes to everything because you just want the money. And it takes discipline to say, you know what? No, we can't deliver that. I won't deliver that. That doesn't make sense for my product roadmap. And these are just a couple of examples where it's easy to say yes to something that makes zero sense operationally or even in terms of your values, because overpromising, if you boil it down, I don't care how you rationalize it as a founder, is dishonesty. You're just dressing it up differently. To say to someone, yeah, sure, we can do it. And then you go in the back and you try to figure it out how, you're not being honest with the people whose money you're trying to get. And that is also lacking values, but that's a different conversation. So
Yes.
when I say discipline is what markets do you want to enter? Where do you want to set up an entity? Do you want to set up an entity in San Francisco because, there's a big hype about San Francisco and there's a lot of VCs there, but really there's 10 other or 100 other startups developing the same product as you. So your customer base will have to choose between you and 99 other products. How does that help you as an early stage founder, for example? Whereas you set up an entity in a jurisdiction where there's not a lot of founders, there's not a lot of VCs, but this means government is welcoming to any startup willing to move there. They'll roll out the red carpet for you. There's maybe just 2 VCs there, but they look into you and they have a conversation. They look you in the eye and they try to get to know you as a founder rather than just going through your deck. So all of these decisions take discipline and long-term thinking, but I go back to discipline as the main core definition of what I try to look for in people.
Yeah, that's interesting. Would you find that some founders, if they go for, let's say, vanity metrics, or if they have their own ambitions, that sometimes, like you said, they might overpromise. Some maybe they do that, but would you see it as a strength as well in a way? And maybe it's what is motivating the founder to deliver more, or do you think that is always a red flag?
It's always a risk. And look, I've pitched as a founder. I've been in the same room as founders pitching. I've heard pitches as an investor. I've been in the same room as VCs while they hear pitches. I'll tell you a secret. Before discipline, I used to say trust. The reason I don't say trust right now is because I think trust is a product, not a virtue. So trust is something that people feel about you depending on a set of values that you show, discipline being the main one for me. I know you're bullshitting me if I don't believe that you can deliver this feature. I'm going to ask anyway, but maybe it's a test. Maybe it's a moonshot goal, so I can see how much I can squeeze from you for this little bit of cash I want to throw at you that I know you're kind of desperate for. So it's always a risk. You think you're smarter than the investors. You think you know things they don't. Often it's the other way around. The only thing that you know that the investor doesn't know is if whether or not you believe you can deliver this feature. But about anything they ask you, about anything they ask to add on the roadmap as milestones, about how confident you feel about your product, about how confident you feel that you can take over this market that you're presenting on slide 3, about how confident you feel in your team. All of this, you're not selling anything to the investor. The investor already has made a decision on whether he believes in you or not 99% of the way. What you do on that pitch meeting is the 1% that'll either confirm or still leave the investor in doubt. So if I'm going into a meeting, I already made a decision if I believe you and your team and your product can return to me my investment in X amount of months or X amount of years. I'm just trying to get from you a sense of whether or not I will still believe in you in 18 months or 7 years when it's time to get that money back.
The consistency.
That's what the founder doesn't know. So founders think they know they know what the investor doesn't, or think they're in control. 9 times out of 10, the investor sees right through them. So it's always a risk. If as a founder you feel confident, you say, no, I can deliver this in this amount of months, I'll get you the return for your investment, I'll expand the team, I'll take over this market, the investor has already made a decision that you can't, or that you can. So you're not persuading him of anything. And if that person has decided that you can't, by sounding overconfident, he doesn't see it as a strength. He just sees it as bullshit. And that's when you get burnt. Because when you leave that meeting, you'll leave that meeting thinking, oh, I was really able to sell this. But the people leaving that meeting are leaving it thinking, this guy's a bullshitter. Don't call him again. And that's it. And I swear to you, I've seen the eyes on both situations from both sides. I've been with founders pitching, thinking, yeah, I think we did a good job. And I'm thinking, no, you blew it. He saw right through your bullshit. He knows you're lying. We will never listen. We will never hear from them again. And guess what? We didn't. And I've been on the other side where the person, doesn't matter who, deciding to invest, said, you know what, I think these guys are overselling. I don't believe they can do it, just as I didn't believe before we got into the call. And, a day or 2 days later, the founders are writing saying, hey, I feel really good about the call. When can we do some due diligence, take the next steps? And I'm like, yeah, they don't want it, So yeah, it's always a risk to oversell is what I would say.
It is overselling. I guess that's the right word for it. And it goes around much more than that, which is sad though, because maybe many of these projects are actually good. Founders, they have maybe their pitch was good. But like you said, actually that you kind of went ahead and answered my next question, because I was going to ask you how would the investor know, and would they be aware somebody's over promising? And from your experience, obviously that's something that stands out. We can see the risk in the long term. Something that as a founder, that's why I think founders and small starting teams, they do need someone to guide them, coach them, because these are things that do come with experience, and
absolutely
getting the right view, the right eye in the industry would actually guide the whole team in place. Yeah. So this brings me to my to my next question. So thank you for answering that. It's very interesting.
Absolutely. I would add though, a more important question, because when you sound overconfident, like, again, I promise you, investors know you're overselling. Investors look at your track record, your online presence, other companies you started or not, other jobs you had. They will make calls to try to see what the feedback is from having worked with you. When you get into a meeting with an investor, he's decided his way, whether to invest or not, 90% of the way. I promise you. That call where you think it's all or nothing is only the other 10%. And he'll either confirm he doesn't want to work with you, or he'll confirm that he does want to work with you. Yes. The one question that as a founder, it's more important to answer is to prove that you can learn lessons faster than the mistakes you will make. Because the investor expects you to make mistakes. They expect the market to turn. This is what I tell the people I advise. They expect you on both sides. They expect you to make mistakes and the market to turn on you. What's important to show is that you can make mistakes, but you will learn the lessons faster than the mistakes you will make. And that's being honest. And a great way to prove that, so if an investor doesn't know you, a great way to prove that is to show them your track record. Give them names of people that you have worked with. Show them projects where you have worked at before. If you don't have the know-how, show them people that you have onboarded into your project that do have the know-how. So maybe you have not had a multi-million-dollar exit. Get an advisor who has, for example. Yes. So showing a track record and showing an online footprint is an amazing way for you to show that you do have the know-how about and around you that will allow you, again, and I repeat this, to learn lessons faster than the mistakes you'll make.
All right. Learn lessons faster than the mistakes we make. That is
Yes,
pretty deep insight. I would take that. I would definitely call this later on. Thank you for sharing that. Yeah, it's in the way it's what we it's what makes sense in the long term, right? So I guess it's basically adopting a long-term mentality in pretty much everything you touch because it's not all about the pitch, right? You see many projects they practice and they as if the final moment, right? I guess the decisive moment, it goes beyond the pitch. It's the pitch is just one of the decisive moments.
It's before the pitch. I guarantee you 90% of the decision from an investor, whether or not we will invest in a project, 90% of the decision is made. We're inviting the founder to pitch just to confirm what we already know. We either decided to invest based on everything we've seen and we just want confirmation, or we've decided not to invest based on everything we've seen and we just want confirmation. That's it. It's never zero. We're never neutral in the middle at zero when we first see we first see a startup in the call. And this is something that people need to understand. And that 90% is made from your track record, again, your online footprint, the people you've worked with, the project you've been involved with. So this is something that people need to understand.
All right, thank you. So we'll be going to the next. So this is very interesting. Actually, we could spend a lot of time on this 100%. Topic because it feels as it's a pillar actually in building trust and actually have a foot in industry. It's
absolutely.
Yeah. So on another, well, it's pretty much connected a bit with the same journey. But if you're designing a digital infrastructure ecosystem from scratch, and we just mentioned earlier that the investor would look at presence online as well. So what are the first three things you would build before inviting the world to invest, before putting everything out there? Here we are online. This is us. We're looking for investors.
Very good. Okay, so first of all would be a product that solves people's problems today. I would not build something that is aimed at the latest bleeding edge technology for a problem that might exist in 7 years. Yeah, so that's number one, a solution for today. Number two would be a community for validation. So a small group of people, and a small can be 100, can be 5,000. It depends on your product. But a community around a product that says, we don't have incentives to support this product, So we're not bounty hunters, we're not farming airdrops, whatever, other bullshit that a lot of projects in crypto tend to do. But a community that can testify in court that your solution solves their problem today. And number three would be distribution. And perhaps distribution is the most important. I see projects dying every day in the silence of cyberspace on Twitter, and I will always call it Twitter, because they have no distribution and they're great ideas with great products. Especially now with AI, I have a strong thesis that every product is convergent and there will be less and less differentiators product-wise between startups. So literally, there's less and less seats for different products at the top of the pyramid. And the biggest moat, the biggest differentiator I see working for startups today is distribution. Do you have access to distribution channels? Can you get your product on YouTube? Can you get your product on Twitter with thousands of followers? Can you get your product on podcasts, which is why what I think you're doing is so amazing. But the third would be distribution. So to recap, if I'm looking to attract the attention of an investor, I would definitely go for number one, a product that solves a problem today. Number two, a community. Number three, distribution.
And, well, this is very interesting. You're saying this because even in the marketing point of view of things, you do see things have changed so much in the past few years. So we don't most of the projects don't appear as pushing narratives like, "Hey, we're on a blockchain," or "We're we have lower fees," or we might have that in different contexts. But overall, I mean, the futures of a crypto project like Web3 in general, they become pretty much standardized. So you cannot advertise the, "Hey, we're on the blockchain," and then your next door neighbor, they also say, "Hey, we also," because now it's the norm. So it is on the blockchain. So we just to resume what you say, it's the differentiator has to come from a different angle nowadays. So
Absolutely.
Different projects in the end, they use the same technology. Everything is standard at a certain point. So the differentiator has to be more obvious. Yeah, thank you.
Absolutely. The capital is tight and the startups are desperate. So everything is converging to the same narratives that work each cycle. And you got to find a way to stand out. Distribution is the way.
Absolutely. Another question, since we're kind of diving in a bit on the Web3 marketing aspect of this. How can, in your opinion, how can founders tell the difference between real traction and incentive-driven noise?
Does your community have any incentive to use your product or not? And by incentive, I mean not organic incentive. So in other words, are you paying your community to stick around with short-timed incentives like maybe yield farming your token or airdrops? Are you spending a lot of budget on KOLs, for example? Or has your community grown organically around a problem they had, which your product tackles? This is kind of how I would see it. Are you spending money to keep people around? Yes or no? And if not, then very highly likely your community is built around a solution you've given them. If you have a budget for the people in your community and you have to spend money for them to stick around, probably that's incentive-driven noise.
What about I see the importance of community overall, and that's something core defining in Web3. But there's another aspect of Web3 that we don't really mention much. There are Web3 projects that they come in physical form, right? Like a vending machine, or for physical products.
Infrastructure.
The infrastructure, would you find community still stands at the core, or would it be leaning towards something else?
It depends on how you define community, but definitely not community as you would define an online community of people who get together with shared values that converge onto your product because they relate to it. I would say especially infra projects, so infrastructure-based Web3 projects, to name the whole thing.
Yeah.
I think it's easier for them to offer a solution around people converge rather than an identity. We saw the peak of identity-driven community with NFTs, which we all know where they went.
That's
But
a yeah.
at its core, memetics. So let's say meme-driven rationalizing for a community was about identity, because there was no solution around what a particular meme project offered, but they all identified with its nature, which is perfect and fine and dandy. With infra projects, if you have, for example, a cell phone charger in a subway station that somehow tokenizes its use, and I can go to its app and I can spend tokens to charge my phone. More and more you see projects like this, but me and my grandmother probably use this cell phone charger, and we use the app, and as simple as it is, the better. But it's not that we share an identity, me and somebody's grandmother. What we share is the need for this
Exactly.
product. So I think it's more difficult to have identity-driven communities around infra-based products, but what connects people together still is the use for the product. Now, do I know this grandmother is part of the same community as me? If I see her using the same phone charger, are we going to start a conversation based of that? Probably not. So it depends on how you define community. But definitely, if you want to, sure you can, but you have to find another definition, because it's definitely not around identity. Yes, it's you could also say more and more Web3, which is what brought Web3 communities together, is being pushed to the back end, into the background. Yeah. So maybe the future of Web3 communities is not even knowing their product is based on chain. You just want to use the solution. Yes. I use QR codes every day. I couldn't care less how a QR code works. I just want to scan the thing and it takes me somewhere else. I don't care if it's on chain, off chain, if it whatever technology. Literally, I don't know. I don't know how even to address it, because I don't know and I don't care what's behind a QR code. But millions of people use it every day. Where there's a community of millions of people who use the
Exactly.
QR code every day. And I don't care how it works. I don't care who else uses it. I just wanted to do the thing I expected to do. So maybe that's the future of Web3 communities. We have to let go a little bit of this vanity of, oh, we're all Web3. And we just need to focus on, here's something that works. And that's it.
Absolutely, something practical. It's in the end is more
Yes.
valuable than wearing a name tag on your T-shirt, right? So,
People
but
don't
that
care.
it comes to a moment, maybe yes, but in small things, you're not just proud of QR codes, even though we do use it every day. That's a it's a very good point, and I do
Yeah.
find I do share your vision on that. Because in the end, you want to press the button, you don't want to hear the song. You want to skip the song, maybe just get your drink from a vending machine, not hearing a song about blockchain, right? So it's a
Absolutely.
technology behind thing that actually you want the speed, you want the lower fees, maybe you want the instant results, right? Not necessarily. Wow,
Utility.
look at me. Yes. It's you want a utility, not the word, the blockchain behind everything. That's true. Oh,
That's why from the
yeah.
NFT market, the very few projects that are still kind of having some traction are utility NFTs. So they do something for you and you don't care it's an NFT. You get access to a festival or to a concert and your ticket's an NFT. All fine. There's a smart contract that ties you to ownership of a house, and that smart contract is issued as an NFT. That's fine.
So
That's why
tokenization, yeah, that's
utility-driven NFTs are still kind of making it. Everything
exactly.
else is kind of gone.
Yeah. Well, tokenization, it does look it's spreading pretty fast these days.
If you like how this is going so far, don't forget to like and subscribe. Thank you for watching.
Okay, this very interesting conversation so far. I think
I agree.
our viewers will have a lot of insights to take. It's another thing why what kind of motivated me to do this podcast and kickstart everything, because you do find many projects there and podcasts and materials mostly for entertaining purposes, which is fine. Some are really good. They do have some useful insights, but you don't have something a bit more in the industry to say, okay, let's go in the middle of everything and see how does this work? How do founders even start? And I was wondering what is one mistake that ambitious founders keep making when they try to build globally but too early?
I think the biggest mistake is actually not so much about the market you reach for your user base, especially in Web3. It's easy to access your markets globally. Transactions are made in several forms of crypto, whichever one you prefer. But you did touch on something interesting, which is crypto is, or Web3, let's put it, is getting institutionalized in the sense of it's coming closer to institutions. And there's no way to do this without getting closer to how institutions work. This means regulatory bodies, this means compliance, this means legislation. Yes, I've seen this, and I was part of this effort at Gate.io when I was opening up Gate entities across different legislation or jurisdictions. I saw this with 1inch when 1inch was getting closer also to institutional banking as well. And I see it here in El Salvador, where from the government side, extending rails to institutions, to capital, to startups. I would say the biggest mistake, and to answer your point, given this context, is for founders in Web3 to think that they can scale a business remaining pure Web3 forever. Yes. It's like thinking that a true DAO can be a DAO forever. Yes, it's fine. We all would love to see a DAO be a model for running a small country, but I don't see a way for it materially to happen. So the biggest mistake is often thinking you're going to be Web3 forever and not considering in your scaling that you need to think like legacy institutions. And where this reflects materially is, for example, where you choose to open up your legal entity. Which jurisdiction? Dubai, Europe, Delaware, Panama, Bahamas, Malta, Lithuania, Gibraltar, Singapore, Hong Kong. All of these have advantages and disadvantages. And often founders spend more time thinking about their company's name than where they're going to open up an entity. And where they're going to open up an entity will potentially impact their first 3 to 5 years as a company. It impacts from whom you can get to raise money. And any serious investor won't just send you a bunch of USDT or some weird tokens. They'll want it done the proper way. It'll impact which customer base you can have. It'll impact where you can hire people from. And I'm sure all of this sounds like, oh, we're not corporate. We don't want to think about these things. We're Web3, so we don't want. What you're showing me is a dangerous level of immaturity. If you think about these three things and you think, oh, I'm not corporate, I don't have to think about this. Yeah, well, guess who's corporate? Tether, A16Z, anybody from the VNTR kind of investor base, any exchange that's serious. The people whose money you're going after as an investor, they welcome being corporate because that means sustainability for the next 15 years. If you're coming up with a mindset of, oh, we're not corporate, we want to be small, we don't want to be corporate. Yeah, well, guess what? I don't want to invest in you. How's that? So the biggest mistake I see from Web3 founders is rejecting long-term thinking as corporate, and they don't want to be that, while still wanting to grab the attention of AWS, of NVIDIA, of Binance, of Revolut, of MasterCard, while rejecting everything these institutions work hard to become. So if they're working hard to become this, why are you rejecting what they are while still kind of going after their capital and their network and their investors? So this is the biggest mistake I see is investors not thinking long-term and thinking they can make it big while benefiting from the flexibility and the gray areas of Web3, which in itself is a yellow flag, but still wanting to play with the bigger institutions they hope to become one day. So this is kind of the biggest mistake I see.
Yeah, absolutely. That would block them from real funding because they might still get some funding here and there. Maybe their idea is good, but overall, it's if you're not playing the long game, it's not sustainable from what you say is not worth investing in. And
Absolutely right. And it's
yeah,
100% red as a yellow flag. And it does put people on the defensive because if I want to be with you as an investor for the next 7 years, you better be on your way to becoming an institution in corporate 7 years from now. You know, I'm not putting money into you so you can stay a degen forever. That's not how the conversation should go.
exactly. There must be a time and place that is acceptable. Like we've seen with several startups, even in the AI sector, that we've seen they had their degen moment and their core team maybe starting in a garage, maybe somewhere, right? Like the very, very early stages. I get that that's still acceptable. But in the long term, if you look back at there wouldn't be any Spotify right now, or if they would forever stay at that level. It's just as
Absolutely.
one example, but I've been following also AI a bit, and I did love how things on Lovable side
Mhm.
advanced, and they did pretty good their timing on the market and their go to market approach. But they were still there's I think everybody kind of coming from there. That's a starting point, a little bit of a degen. That's how ideas come to be, and but at one point it's not part of growth anymore. So on the same aspect as you did mention laws and compliance and that building towards a more corporate environment and compliant. But some projects do overdo it, in my opinion. So when do you think that happens and they take it to a different level where they wouldn't add some features that maybe it would benefit their app or their project, and maybe they wouldn't say certain things in their go-to-market approach that maybe they should say that it's not necessarily a red flag, but because it's somewhere in a gray zone.
Mhm.
And I feel, do they miss opportunities, or is that ever too much of being too compliant, especially in emerging markets like El Salvador and in Latin America as well? Where would you see this?
I don't think there's such a thing as being too compliant. I mean, let's look at the definition. To comply means to obey. And as long as you have your goals set straight for your company, if you obey something coming like an imposition come from the outside, you should be able to explain how that benefits your business. Yes, otherwise there's no point because often requests to comply mean constraints. So if you choose to comply with something as a founder, you should be able to explain how complying with this norm or this regulation or this law supports your business. Maybe it's expansion into a new market. Maybe you can access through El Salvador, you can access a market of 5 million people or 50 million people in Central America. And therefore, you need to comply with the Salvadorian digital assets regulation, for example. So, as long as you can explain how complying benefits your business, I don't think there's such thing as too much compliance, so to speak. Yes. What's the offset? Because if somebody's making a decision not to fully use the technology behind blockchain to make things faster, more transparent, and secure, and they're doing things manually to comply, for sure there's an offset, meaning there's something to gain from complying. Maybe it's the ability to offer their services in a certain country, for example, where you are right. If something goes wrong and funds disappear, somebody needs to be accountable. You, Stefan, as a customer, if you have your money in a wallet or an escrow and the money goes missing, would you be satisfied with an answer that just points at the tech and then the startup or the project or the product disappears, they open up shop somewhere else. Would your response be, oh, I'm satisfied that there was something wrong with the tech or a vulnerability was exploited. We know who did it, but I don't know the person who permitted that to be exploited. So I don't know if they'll be accountable, if they'll do it again, if it'll happen to somebody else. How will I get my money back? So when it comes to customer protection, I have to say, I tend to be for regulation and for compliance and for legislation. And I do find that in ecosystems such as Europe, where people complain a lot about regulation in Europe,
Absolutely.
I
Yes,
try
yes.
not to, because often the people who complain about the regulation in Europe, they're trying to make another point. So I try not to feed into that conversation. And there's a lot of, I call them useful idiots in Europe as well, who talk trash about their own home,
Sure.
serving somebody else's narrative to draw talent and potential and money and startups away from Europe. But we don't need to go into that. So
That's right. Yeah.
I try not to replicate Europe denigrating, let's say, comments over regulation, but I myself tend to be for regulation that protects the consumer, because I care, as a consumer, I care more about that than somebody's right to make profit. But that being said, usually if somebody goes and chooses to comply with a certain jurisdiction's laws and norms, there's an offset from that. And usually the offset is, yes, we're not fully using the technology, but until the jurisdiction keeps up or catches up to the technology and regulates the use of the technology, we're happy to do it manually because this gives us access to this market. So there's usually an offset because nobody wants to do things by hand just because. So this is kind of what I would look like, or what I would look to. Here in El Salvador, I think that problem doesn't exist so much because El Salvador, much like Singapore, much like Dubai, is creating the infrastructure before the demand arrives into the country. So whether it's the physical infrastructure, with El Salvador was, by the way, the first country to buy, I think, 200 of the H300 chips from NVIDIA. So they have sovereign AI infrastructure. So strategic AI projects aren't stored in the cloud of some other country. They stay in-house. Also, with the digital assets law and with the Bitcoin law. Now with investment legislation that is coming to attract smart investment into the country. So El Salvador is investing a lot in creating very attractive regulatory framework for investors and for startups to come into the country that, much like Singapore, much like Dubai, is the legislation that will serve the people who will be here in the next 20 years. So today, the demand is just finding out about the country, but the legislation is in place that serves what the capital and the operators will need in the next 20 years.
Yes, it's good being compliant, but at what is the cost sometimes? And this is something that we don't address, but eventually it does get built up from what I've seen in the past few years. There's always a new law. I guess patience does work in certain situations instead of pushing something that would put all the users at risk, which we've seen that in the past, unfortunately, in Web3.
100%.
Another thing, talking about El Salvador, I've heard some gossip at times. I wouldn't really call it gossip, but because blockchain, right, is supposed to be accessible for everyone and everybody should be able to use it, but more remote areas, they don't get access. There's a problem that existed always here in Canada as well. We had this at a certain point. So there's always some communities that's being left out, sometimes maybe not in purpose, but how do you think there would be a better distribution? Since we did mention distribution, is this something you would see that's coming ahead, or is something that's being implemented as we speak to improve that?
Yeah, for sure. I mean, at the end of the day, it doesn't matter how good the technology is. People are always free to onboard it or not to onboard it. There's people today that still use technology that was available 20 years ago, even though there's options for them that are better. So that's the beautiful thing about innovation is it has to be competitive and attractive enough for people to want to use it. So if we think about technology that exists today that still hasn't been fully onboarded by people anywhere in the world, but let's take El Salvador. I would take that conversation to the innovators and to the technology developers, and I would ask them, what are you building? Because, whatever it is, these people still don't want it enough to use it, And look, people are using there's that problem doesn't exist here in El Salvador, but there's countries in the world where people still don't have smartphones, and most people still have dumb phones, quote unquote. And some projects found a way for you to exchange stable coins and crypto through a dumb phone, like a Nokia 3310, for example. So, and people use it more than they use smartphones, more than they use laptops, more than they use banks. So,
It's practical. Yeah.
So it's not about penetration into certain areas, I would say. It's about the technology. And this goes back to something I mentioned before. If you're trying to solve problems that may or may not exist 7 years down the line, don't be surprised that the people today aren't onboarding your product. So that conversation, I would always take to the technology developers and ask them, hey, whatever you're building, these people don't want it. So either build something they want or don't complain that, some countries aren't really adopting the technology that is there. One point, for example, one point in case that I really see an opportunity here in Central America overall is remittances. So money coming in from Central American immigrants in the US, typically, where they send money through Western Union, for example, at atrocious rates, meaning taxes and fees.
Compared to
And
blockchain.
the percentage of the money that never gets here because the middleman, that's Western Union, gets a cut. This problem is being solved and can be solved on chain and through easy, simple stablecoin transactions. Nobody has done it simple enough, sometimes even from the UX perspective, that millions of people here would onboard it. But the concept is simple: to take a fraction of a centesimal of a percent is better than to take 2 or 3% cut out of however much money your family member in the US is sending you over here. So the solution is obvious. Why aren't people onboarding it? Nobody has made it simple enough, where
Exactly.
a grandmother can scan a QR code and get the money. So it's about developing the technology, and I always put it on the other people, So if children and grandmothers in Central America have figured out how to scroll doomless, or rather how to endlessly scroll on TikTok, and they figured out how to onboard them onto TikTok, which does nothing but to take away years and days of their life, for sure, somebody can come up with a system that is monetizable and easy enough for those same children and grandmothers to get money fee-free or almost from the US. So yeah, I think it's about making technology accessible more than where geographically this kind of
I'm pretty sure there's some founders. Pretty sure there's some founders out there right now that they're actually working on this as we speak.
I know a few of them, and it's about reaching a balance between also how you monetize your technology and what you give it. Because if this was something that you would be given a $10 million grant for free to develop, some people would have done it already. Exactly. But it is a competitive space, and it's about how much you want to monetize it.
When a founder says we're building for emerging markets, what do you immediately look to know whether the founder understands the market, or do they just throw in emerging market because it sounds cool? Like what would make someone make it or break it when you hear that from an investor perspective?
How easily can they explain the problem they're solving? Like, if you can convince me you're solving a problem people have today, then I'm paying attention. Yeah. If I see you struggling, creating this whole narrative of how what you're doing affects this, and then point A to point B to point C, and indirectly affects the people, you lose me. I don't care. But if in 10 words or less, you can make a straight connection between your product and how somebody's life is made easier or better, then I'm paying attention, because then I understand you respect the problem enough. And this is a huge problem with founders. A lot of founders fall in love with their solution especially technical founders. And then they try to draw around the solution to find a problem that that solution solves. Yes. So it's like throwing an arrow at a wall, and then you draw the target to make it seem like that's where you were pointing. A lot of founders do this. And we go back to the vanity where you feel so
Absolutely.
smart, you feel so intelligent, you love your technical solution so much, it's so elegant, whatever, that you try to justify how that solves a problem when it really doesn't. Whereas if you fall in love with the problem, you're going to go through the first solution or the second or the fourth solution. You will iterate as long as you need to solve the problem you fell in love with. And that to me is a much bigger predictor of success. Because if you fall in love with the solution, that's all you got. You'll ignore the market, you'll ignore the numbers, you'll ignore the results, you'll keep pushing, burning money, other features, whatever, try to make that solution work when the market is telling you it won't. And often it's something else. Often you'll realize this solution you came up with is everything you've got. It's the only thing that makes you a founder. And if that crashes and burns, you have to go back to that 9-to-5 job and you have to be an employee like the rest of the world. And then you lose your founder status. So I look for people who fall in love with the solution, because to me, founder is something you do. It's not something you are. So as long as you keep working towards that solution, you're still doing what a founder does, and that still makes you a founder. So when I hear founders talk about, in less than 10 words, here's how my product makes somebody's life easier in an emerging market, then I pay attention to, because then it tells me you have what I mentioned earlier, the discipline to keep working at that problem until you solve it for those people. And trust me, if there's something people in undercapitalized markets have, is problems. You kick a rock here, you find 3 or 4 problems that anybody in Silicon Valley could solve, but they don't want to, because Silicon Valley is more hype and more attractive than actually solving people's problems here.
Exactly. That's what makes some projects interesting, the problems they're solving. But at the same time, at the bottom of it, is it fundable, right? So, because you've worked with portfolio companies across many countries, and I guess you have a better understanding on this. What would be, in your opinion, the major difference between a great vision, interesting project, and an actual fundable startup? What would be a major differentiator in this one?
The founder. It's never about the well, it is, but it's at the end, if it's, flip a coin because I'm undecided, it's always about the founder. And what's specifically about the founder? It's trust. We go back to the trust.
Trust layer, yes.
The only answer an investor is answering in his mind when he's looking at a founder is, do I trust this person? And I promise you also, 9 times out of 10, when an investor decides not to invest, in his mind, he answered this question and he said, I don't trust these guys. It doesn't mean they're bullshitters. It means I don't trust them to deliver, to be the people who can solve this problem, to be the people who can get the people to solve this problem, to be the people who can access the market. So it might be operationally that I don't trust you're the right guy. It doesn't mean I think you're lying.
Trust them with the money, yes.
Exactly. Sometimes it is about, sometimes it is. They're bullshitting, they're overselling. But often it's also, I don't trust them to be the people who can solve this problem for X, Y, or Z. And when they invest, I promise you 100 out of 100 times, it's because they do trust the founder. So that's the only question people are looking to answer, really. It's do I trust this person, yes or no? And that's about the founder. It's not about the product. It's not about the roadmap. It's not about the market. It's about the founder. So differentiator, 100%, it's the founder.
So in a way, it's follow the money where the money would go. Would you basically trust that person with
this
the money?
Person with my money? Everybody I've trusted has embraced compliance, embraced regulation, embraced legislation that supports their business. And I know this is not a popular opinion amongst degens and amongst like Web3, but everyone that I've trusted welcomed transparency, regulation, legislation. Everybody who I've seen, not everybody, but yes, everybody who I have seen make foul plays and rug pull projects, rug pull investors, disappear with the money, had this attitude of let's stay small. We're not corporate. Let's go around regulation and legislation because it serves us better at this stage. Yes, we accept investment in tokens. That's why I mentioned it was a red flag back then. So, yeah, it's about
I
finding a
see.
balance, I
Yeah,
would say.
yeah, yeah. We for sure we still see those type of startups. I would say,
Every day.
but it's yeah, that's a major red flag. That's why I'm not sure if people do fall for it as much as before, but there's still those
Every day people
new to
fall
the
for it.
technology, and yeah, that's where the due diligence come in play. That always it's still valid. We say that like 6 7 years ago. Do your own research. It's still valid today in this aspect.
Every day
But
I see founders disappearing
mm,
with the money from a
yeah,
wallet that only one person was managing. And then they blame hackers or the market, and it's always
there's
always bad
always
luck.
someone exactly. It's always
Never
someone
follow
to
play.
blame except for the action problem. But it's unfortunate. It's things that are changing slowly in Web3 or maybe they're slowing down compared to before. But these things they
Hopefully.
do. I've seen this present very much in the stock market as well, and in the traditional finance. So there's always a way some people diluting stocks and whatnot just to to have something to blame, or it's because of that. But in the end, it does come down to the user's decision as well beyond what, no matter how much the founders are working, because a lot of founders, they're working hard to actually make things work, but then you have this other side that would make the hardworking ones kind of look bad as well, because we all pay the toll when something goes wrong in the they I see many people confuse community attention with ecosystem building. They say, oh, there's a big community and it's for sure it's a trustworthy, and I met this Twitter handle and that Twitter handle. So in the end, um, they might fall for some of these things while just in the hype. But my question for you is, where do you think is the line between the two, between the community attention and actually ecosystem building that founders take seriously?
I mean, it's in the word. It's building. Communities get together over shared interests or identities, and that's the product, is the feeling of belonging. Ecosystems are designed to build. An ecosystem gives you the answers, the people, the resources, the know-how to actually build. You can have a community of investors, mentors, and founders in a city, and they all get together, for a meetup.
Exactly.
That's fine. An ecosystem is when you have, for example, an accelerator where they get together for the purpose of building and sharing what they have, so they all build something together. So I would say an ecosystem is targeted to building something together, where a community is more around just the social feeling of belonging. I belong to the same community as people who I don't know, for example.
Yes.
I like to think that I belong to a couple of ecosystems where the purpose that we're there for is to actually build. So yeah.
So in a way, would say building comes first,
Mm-hmm.
community is coming after, but it is not the main metric to
Yeah.
measure where the project is going. So in a way,
Ecosystem takes intent to build, and communities are often a byproduct of just people being in the same shared space.
we see a lot of founders and teams moving from traditional finance to decentralized finance, and
Mhm.
some they some might take it and might actually learn about why it's called decentralized. Others, they might, oh, I know, I got this, and this is what I did before. It's the same thing. Web 2, Web 3, it's all about the customer. But in the end, things maybe are slightly different. So for someone that's moving from traditional finance to decentralized finance, what would you flag them? What would you say they would be their biggest challenge in 2026?
I would say it's a shared challenge. It's the market. It's building something that you can sustain for long enough to plan ahead, not only reaping the rewards, but also offer a solution for long enough that your product means something. And this is both in DeFi and TradFi. I think the challenge is the same, especially with how the markets are
Actually,
globally.
for the early stage founders, you would see many types of, and I'm pretty sure you've seen that, and you have those already disciplined founders, and they work in a way, they have their own workflow, their own system. But you also have those, I've called them once in a while like a wild card, because you don't see the discipline right away, but you do see the talent, right? So you might have someone that they don't care about anything, but for a good, let's say 1 month, they would be focusing on only one thing, and surprisingly, they would be very good at it as well. Very talented people. It makes me think, like, just as a comparison with early stages of Daniel Ek, the founder of Spotify. It's a study case I like very much because of the chaos that was around that time. And the founder was a young guy living with his mom, and I'm pretty sure I could confidently say it was the wild card. So my question for you is, when do you think that discipline trumps talent? And
Okay.
if that is the thing, and do you think that talent actually trumps discipline at times, or is that a certain phase? How would you frame this?
I would say every time discipline trumps talent. I don't care about talent because talent alone does nothing. You need to put effort behind it, and that's where the discipline comes in. Also, talent goes like this. Like you might feel motivated one day and not motivated the other day, or you might be motivated for a certain feature of your product, but then you figure out the market doesn't like it, and then you kind of your motivation goes down. So all that talent, what is it really is doing nothing. Whereas discipline is constant, it's predictable, and it shows up to work every day, you know. That's kind of what I like to see. It's what I try to
So
apply
it's
with my own life.
investment worthy, in other
It's
words.
investment worthy. It's predictable. It makes me trust you a lot more. Look, if I'm going to give you money and you're going to do stuff with my money for the next like 3, 5, 7 years, whatever, I don't want that to be depending on how you feel that day or your emotions. And I'm sorry, this doesn't sound very human to say, but I don't care about your emotions or your motivation or if you feel your genius is being applied to a particular feature or product. I want you to show up to work every day. I would rather see you go slowly, but in a curve that's consistent, rather than up and down. And maybe one year you're motivated, but then you ghost me for 6 months and so on. So I would say it's discipline all the time, always. Also, specifically with founders, ego tends to be a big thing. And it's interesting because I don't know if I mentioned this to you, but I studied clinical psychology. It's my master's academic background.
Oh, that's very interesting.
Some personality traits you cannot dissociate from others. Everything exists in a web of interconnected traits inside the person that you are. That's the self. So often big talent comes with big ego. And I've seen ego get in the way of potential so often, and great promising people just trip over their ego as well. That you can't have certain traits without having others. It's
Yeah, absolutely,
and
absolutely.
often talent
Yeah.
comes with ego, and that gets in the way of business. So if I see somebody that's obviously super talented, that won't build trust in me. It might even be a little bit off-putting at points, but if I see somebody that's disciplined, then I'm listening.
What about if somebody is coachable? Let's say, well, how would you tell the difference? Because there are people like the wild cards, but they present as such, and then maybe
Mhm.
they're coachable, maybe they're flexible. Is there something like a sign that would tell you that, or something that should founders work on and improve?
Yeah, I mean, what I try to listen for is maybe evidence of changed behaviors. So if somebody is a huge talent and I see is at risk of also having a huge ego, but they naturally, almost even without realizing, talk about how they learned lessons from the market. They were frustrated by the market. You know, they had arguments, material evidence that their thesis was wrong. And they very natural kind of, without trying to sell you on it, because that's also something they'll try to do, but we'll just naturally tell you about how they reiterate or how they kind of shift their focus or their direction based on evidence. That tells me that they're teachable, you know. On the opposite hand, when somebody comes into the conversation and blames the market, blames the partners, blames, the team, blames everybody else around them except their genius for the failures they've had, that's a red flag. And then I stop listening and I'll cut the meeting short.
Yeah, I can see that happening. I can say, especially some founders, they do take that very because it's it's their baby, right? Like some put a lot of time and a lot of personal investing in it. But yes, I do see how discipline makes such a big difference in founders and adopting this mentality. There's just one
Absolutely.
last questions because it's not always as black and white per se. At times life happens, right? So there are unexpected things. Now, I guess that's where and when discipline matters more because you can still deliver despite the this is what I'm getting from what you're saying so far. So that in your opinion, that's one of the factors that discipline might trump over talent
For sure.
in the long
Even
term,
even in your life,
especially.
look,
Hmm.
I try to implement like I try to live by a couple of I think like four main virtues that anchor, and I try to exercise those virtues on a daily basis. At the end of the day, I practice some gratitude and I try to self-check and self-audit. You know, did I exercise these four virtues on a daily basis? One of them is discipline. Uh, and what happens is when you practice discipline, and I've noticed this about myself, the more you expose yourself to small, controlled contrarieties, the better prepared you are to deal with big, uncontrolled contrarieties. So on a daily basis, if you wake up at a quarter to 4 in the morning, which is my case, what I try to do.
Oh,
So
that's very.
3:45 every morning, my alarm is going. Um, for the past 3 years, I've only taken cold showers. Like I don't know what it's like to touch hot water for the past like 3 years. Doesn't matter if I'm in Canada, Germany, Poland. If the water comes cold, that's that, whatever the coldest setting is, that's how I'm taking it. If I don't eat every time I feel a little bit hungry, if every time, if it's raining, that's when I go outside for a run. Every time you can expose yourself to a little bit of a difficult decision and a hard thing to do, you should do it and you should definitely make that option, because the more, and I really believe in this, the more you force yourself to face small, controlled, difficult things, the better prepared you are to face bigger, difficult things. And so when the market shifts on you, when your roadmap has to change, when your runway, when you run out of liquidity, when your partner wants to exit and that kind of leaves you alone in a huge gap in the knowledge base needed to run your project, you're better equipped to deal with that based on how you live your life when you're not under that stress. So discipline again goes towards that purpose. If you have a brilliant idea for a feature in a new product line, but you understand that answers nobody's problems and your customers are not asking for that feature, the discipline comes in and you don't develop it and you don't waste effort and time and energy on it, and you just focus on what your best performing product is and you know how to say no. So on the topic of discipline specifically, there's a number of reasons why I pay attention to that particular trait in founders.
That's great. So, well, you just mentioned liquidity, and that's where this conversation was going next.
There you go. Let's go.
On yeah, so on because you cannot have a Web3 project, in my opinion, and not actually be aware of liquidity, about tokenomics in general, and how does the market work beside the actual technology. So you would kind of have to have a understanding, in my opinion, of what fuels the whole Web3 economy. And this is what I see some people coming from Web2 moving into Web3 um, in their marketing techniques, and many startups as well. I see they tend to not reflect on that. It's kind of ignore it completely, as if it's, well, we'll be fine with paid ads or whatever the funnel's working at that moment. But where do you stand in this? Do you think that tokenomics and knowledge of that, is it still fundamental no matter what project are you working on, even if it's like we're talking about a vending machine or anything, as long as there's a token involved? Do you think the founder should be aware of tokenomics and marketing behind it as well?
For sure. I mean, you need to be aware of whatever industry you're operating on. Now, do you need to be the most knowledgeable person in your company about it? Probably not. Probably you can buy that knowledge. Also, I feel like with AI and LLMs today, the barrier to access knowledge has been lowered so much that it's almost inexcusable not to be aware of, for example, tokenomics if you're in a Web3
Yeah.
project, because you can just like bring yourself up to speed. Like, you used to have to go to courses for these things. Then, let's say Web2 came along and you could access what other people were saying about these things. So you didn't have to pay courses. You can just be in the right community. Then Web3 came along and you can now own the data. So you publish data and you consume data and you own all of the infra. So every iteration of web, let's say, it became more and more accessible and accessible to have knowledge and inexcusable not to have knowledge. So for sure, Web3 founders need to be aware of tokenomics. Now, this is different than saying every Web3 project needs to have a token. Absolutely not every Web3 project needs to have a token. 99% of the Web3 projects, I would say, don't need to have a token if you look at a token from a utility perspective. Now, call me old school. Can we already call people old school in Web3? I guess so.
Well, yes, nowadays, yes. If you're
Call me old school, but I do feel like tokens should be about utility and not just about liquidity, because liquidity is when the conversation starts getting murky. People just want to get the money. They just want to fund whatever side projects they have.
absolutely, yes, yeah.
Often liquidity is used as proof of work in the absence of work as well. So there's a number of I would say, side quests you can pursue by launching a token. But if you're focusing on a token around utility, for sure, it's good to understand tokenomics. So if there's a market case, if there's a use case, if there's a good argument to launch a token that serves and solves somebody's problem, you should be able to spot that opportunity. But it doesn't mean you should go and launch a token just because you understand how it works.
Yeah,
It should be
absolutely,
there.
absolutely.
Yeah.
Yeah, the token it needs to you basically have utility first, token after. Token doesn't come first all the time. But yeah, some projects do have a token, especially in case of payment rails and stable coins and other similar type of projects where there's a need for a token, right, for transfers and but overall, if you that's another upcoming question. I like the flow today. The flow is really nice, and where this conversation is going, because yeah, you do have protocols sometimes. So especially in 2026, this year, we've heard a lot of talk around privacy protocols and this type of project. So not necessarily privacy coins, right? So it's more the protocols around. There's no need for a token in many cases for a protocol. But
maybe you can have a token for governance,
Yeah.
for example. Maybe there's a
that
number
could
like just
yeah.
managing the infra. It's fine. It can be within a closed ecosystem. It's fine.
be a
But 9 times
community
out of
thing,
10,
yes.
yeah, maybe but 9 times out of 10, you talk to a founder about the token and you can see their eyes going ka-chink, like the dollar sign. And that's definitely not the right reason why you should launch a token.
So that's understandable, and that's going back to my question with the protocols and privacy coins. So there's something that stands out this year, in my opinion. There's a lot of work around privacy and the privacy
Mhm.
protocol. So we've seen that obviously Star is one of the chains that there are actually quite a few, and there's a lot of founders, builders on several chains. I would even add Solana to this and everything else. But yeah, my question to you is: everybody's working on privacy this year, or at least it
Mhm.
feels like it. So the market is competitive, so everybody's kind of building and racing to build the same thing. What do you think that would make the winning team, and what do you think in a market where everybody's kind of building something similar or trying to get the same results? What are the teams that will stand out in your opinion?
Interesting.
No matter the chain, I was like no
Yeah, yeah, yeah,
favorites here. It's just
for sure.
overall,
Um,
because it does happen often that you do have several teams building similar
yeah,
projects. I mean,
I would say.
yeah,
I would say what sets them apart is the same as what sets, startups apart. And you just touched on a topic that I mentioned earlier as well, which is, every product is convergent. Everybody's working on the same things. Everything that comes out looks more and more like the same thing. So the overlap is becoming more and more, and all products of a given nature start looking like just the same thing. So with privacy topics, much as with any other tech product, I would say coming out in blockchain or elsewhere, I would say with all product being convergent, it's about distribution. So I don't
yes,
care what chains are working on privacy. I care about privacy for sure. I consider myself, and I'm sure you too,
yes,
to be one of the
mhm,
lucky ones to exist in this bubble where we're educated enough to know why it's important and how to
exactly,
integrate into our lives. 90% of the people, more 99.99% of the people out there have no idea how to improve privacy in their own usage on a day-to-day basis. So the team that makes it, I feel, will be the one that cares at least as much about distribution as they care about the actual product. Yeah. So look, don't tell me that you're building a great, privacy feature for your chain. I don't care. I'll get the same arguments from everybody else at this, goddamn
yeah,
conference. Tell me about what efforts are you developing to educate the audience? Like maybe you're
yes,
doing a boot camp. Maybe you're having some online courses. Maybe you're within a community having some champions that instead of going on and on and on about how cool and how different your product is, which is
super,
not, that are actually doing classes, 500 people at a time, 50 people at a time, doesn't matter, 5 people at a time, educating the audience on why privacy matters and why they should use a product. I remember, for example, how I learned to use a wallet? MetaMask had 3 videos of how to use a wallet. And obviously, the wallet they teach you to use on those educational videos was MetaMask's wallet.
yeah,
Guess what I
exactly.
did after those 3 videos? I opened up a wallet. Guess which wallet? MetaMask's. I didn't care it was MetaMask's. I wanted to know how to use a wallet. I saw educational
Mhm.
content that onboarded me to the product. So I tend to honestly, I space out and I don't care as much about what
Yeah.
product, around privacy any given chain is developing. I'll pay attention when they start talking to me about what efforts they're deploying to educate audiences about why privacy and how privacy into their life. So, to answer your question, much like
Exactly.
with a startup, where it's less about the product and more about distribution, I would say with privacy and with chains as well, I care less about the product. I care more about what distribution efforts they're making to get, to educate the audience.
Absolutely, absolutely. In the end, we get to the same principles that
Yeah.
yes, utility, distribution, and 0 to 1. Basically, whatever
Yes.
goes in between is not something that the customer necessarily wants or needs to know in detail exactly. So that's where
Absolutely.
that's where the hopefully the whole industry is heading. Yeah, in between, we do, now that you mentioned one of the pioneers, MetaMask and Ethereum, and this makes me think of another aspect of things that also this year there's a lot of things in this industry that are happening, and a lot of ideas being tackled. So one of them is building a quantum proof system.
Mhm.
From your perspective, would that be a priority for a founder to learn to adopt? And would you see that a plus for a founder that comes to you and, hey, we're also optimized for pre-quantum or quantum proof? Is that something that you would find as a plus? Or
Yes and no. No at a very, very early stage. Again, go to market with some MVP version of whatever it is you're trying to build. To be honest, the risk of quantum breaking crypto, um, for sure today it can break cryptography. So you can make the argument that today any
could break
project is
anything,
vulnerable.
actually. Today kind of pretty much could break anything. Yeah,
Any
yeah.
so that's also not a moat.
It's
It's
not,
not a differentiating
yes,
factor. And to be honest, it has no interference with your ability to solve somebody's problem with your product. The companies, the projects that should be worried about quantum and should be onboarding quantum safe technologies are probably tokenized funds, anything doing in RWA, um, anything managing for sure stable coins, and anything managing high volume liquidity for sure should be worried about quantum breaking cryptography
exactly.
100%. But for the founder starting today that has an idea, um, look, there's already 100 things, or 100 reasons why you shouldn't build whatever you're thinking about building. Okay. You don't need to add another one because if you start going down that rabbit hole, you'll be discouraged. You'll end up not building anything. But what I mean is, the risk is there. It's going to be there anyway. It's just going to be another reason for you not to build. Don't think about it at this stage. Learn as you go. But today, the most exposed projects are actually funds and projects dealing in high volume liquidity. If you're not one of those, then you probably don't need to be adding, quantum safe tech
Yeah.
to your stack just because,
Exactly. That's kind of bringing me back to what you said earlier in this podcast. You mentioned that it's important for a founder that you'll invest in to be solving a problem that is kind of a now problem, not a 10 years from now problem. So I think it's
Exactly.
maybe come together when you mentioned the two. And yeah, that's kind of all my questions for today. I mean, I do have a lot
Hey,
more questions.
I'm so
So
happy we got to
yeah,
talk, man.
yeah. I do have more questions, but I do hope maybe we'll have a part two someday, and we'll
Happy
continue
to
on however the
happy to
market is
join you.
evolving as well. Yes.
Happy to join you anytime, man.
Yeah.
Look, I've
Thank
mentioned
you.
it. We met each other about like 6 years ago or 5 years ago. I think going on 6 years. And I've always been a fan. I've always liked the way you think. I think we always had a great rapport. So this was really cool, a cool moment. And I'm honored to be the guest of your Genesis episode for your new podcast. So
Thank
more
you.
than
Thank
happy
you
to
for
have been
being
a part
here.
of this, buddy.
Thank you so much, Nelson, for being here. Actually, I always learn something from you. I think you joined the
I
crypto
appreciate you,
scene.
man. Mhm.
You joined the crypto scene quite early. I'm not sure, because when I saw you there, you're already there. So I assume
Mm.
you were in this for a couple of years earlier. So it's
I'm old school, baby.
yeah, it's interesting to see how things have evolved, and the mindset, that because with the market evolving, so does the mindset. And I see, if I spoke with Nelson like 6 years ago,
Mhm.
in the same context, there's many things that I wouldn't even imagine that today would happen. So it's great sharing this journey as well. So I really appreciate having you. Thank you so much for joining.
Likewise, Stefan. I appreciate it, and I hope everybody watching keeps watching because knowing you, I'm sure this will be an outstanding series, man.
All right, thank you so much.
That's trust to traction. In Web3, Trust is the strategy. Traction is the proof. I'm Stefan Furcoi, and I'll see you in the next one.